Okay, good morning. Good morning, everyone, and welcome to our Tuesday market outlook session. So today, I will be walking you through how we are viewing the current markets. And we saw a fairly sizable decline on Friday with fears of the new Omicron variant. And the question really is, how badly is this new variant going to impact equities leading to the year end? Over the last number of weeks, equities have been very resilient, and we were looking strong heading into the festive season, but now we have a new unknown variable in the mix. So today, what I would like to do is to go over the key levels that you should be aware of and to give you a better idea, a better insight of how we are viewing the markets and possible scenarios that the new variant brings. So as usual, quite a lot to get through today. And before we get started, just a quick disclaimer. The types of securities forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be starting off with the major indices. We'll be highlighting some key levels, going over some technicals to get a better idea of market direction. And should markets decline, where will they decline to? There are some unknowns right now, and it's always good to know what the options are to be prepared for different scenarios. We'll be moving on to fixed income and commodities, seeing where they're trading at and what levels to look out for. And then we'll be taking a look at the sector rotational model. We've seen a lot of rotation here in the major sectors here in the last few days. And I think, especially today, it's very important that we go over what sectors are providing leadership and what sectors are weakening, especially with the new news that we received at the end of last week. From there, we'll be taking a look at a couple of subsectors of interest, and we'll be ending today's session with some bullish and bearish market observations. My name is Prakash Vijayanath. I am an analyst here at OptionsPlay, and I am really excited to share with you our thoughts and analysis on the current markets. So starting off with the S&P 500, we saw this knee-jerk reaction on Friday as investors were kind of spooked about the new variant, but price did recover yesterday, and I kind of view that as a positive in the short term. I think I think investors realize that maybe it was an overreaction. We don't know enough about this new variant to know that it's going to be all doom and gloom just yet, but it is certainly an uncertain time at the moment. So again, we have to remember very little known about the new variant, and the main question is whether it will have a big impact on the global recovery. We are seeing a bifurcation in relation to the responses between the US and Europe, where Europe is, even before the new variant was discovered, Europe was starting to impose some forms of lockdowns to combat their Delta wave. The US will likely not impose new restrictions, which is a positive for equities and provides a bit of a defense against a possible slowdown in global demand. So if we take a look at the chart here itself, we saw a strong break above that 453 level. Price did pull back and found support there, which is why we are highlighting it as a key level, as was a previous swing high. But we saw here over the last couple of weeks, price was struggling to really break above that 470 level. And based on the news on Friday, it did gap lower significantly. It recovered somewhat yesterday, but it looks set to gap lower again today. I believe Moderna came out and said that they will likely need a new type of vaccine to combat this new variant. So not great news, but we still don't have enough information. But I do think that right now, especially now in times of uncertainty, we may see a further decline here for the S&P 500. Key level would be the 453 level. That would be the first level to look out for. But should the vaccines that we have now be truly ineffective, I do think that may provide a catalyst for a break below this 453 level here. But again, we need some hard evidence of that. So should this level break, the next key area of support will be 428. And I would view this area just below 440 as a minor area of support as well, as price did find support there earlier, a few months ago, I should say. And if we take a look at the NASDAQ 100, so in my opinion, in the worst case scenario, the NASDAQ 100 does provide a better defense against the S&P 500. as it's more focused on the tech sector, which we saw had a strong outperformance in the first few months of the pandemic. So, and it was really the only sector that provided leadership for most of 2020. So in the worst case scenario, again, where the vaccine proves to be ineffective, and governments impose harsher lockdowns, we may see a similar reaction to the early months of the pandemic, where the Nasdaq outperformed the S&P 500. But there is still some downside to consider here. We are seeing, we saw good bullish move here yesterday. Price is set to open lower the last time I checked. And possible downside targets here would be 390. That did act as support here twice already. And should that level be broken, as it's a fairly minor support level, I think the 382 level would be the next support level or the next key level to look at. And should that level be broken, I don't believe 350 is a long way down. I think that maybe you'd be looking more at around 370 or so, which acted as a previous resistance level in the past. So yeah, a bit more downside here for the Nasdaq 100, but overall, I think it would still outperform the S&P 500. Should we move back to that early days of the pandemic, where investor sentiment was more focused towards technology stocks, as globally, most countries were under lockdown. Taking a look at growth versus value here. So I spoke about this ratio chart 4 weeks ago. I did mention it last week as well. But and I said that we will be looking at this chart more often leading into Q4 earnings, because there were a lot of headwinds at the time that I thought may impact Q4 earnings. But what we're seeing here is actually more rotation into growth. We see a break above this breakout level here around 226. Now, this is a ratio chart, it's not a price chart, so we can't really use technical analysis, but it does indicate just how strong growth is right now. It's set to gap up higher here this morning as well. So, and what we saw here, I think I cut this graph off here, but we saw a strong performance of growth relative to value in the early days of the pandemic. And it wasn't until the vaccine was announced at the end of 2020 that we saw value start to, we saw broadening participation, and we saw value start to perform in the same way as growth did. So again, I do think it's starting to mimic early days of pandemic, but it's very early days to say that. That being said, keep an eye out for growth. It does look like to be strongly outperforming value here. Taking a look at the RSP equal weighted index, and this is quite concerning for me. We are already seeing that underperformance of the S&P equal weighted index relative to the S&P 500. And straight away, that's an indication of narrowing participation. And that's what we saw in the early days of the pandemic. So I am drawing a lot from the early days of the pandemic, because that was when we didn't have a vaccine. And it was not until we received news about the vaccine that we saw the broadening participation. So in the worst case here, the worst case scenario of not having an effective vaccine, I do think it's similar to early 2020. But even then, I don't believe it will have as big of an impact as we saw in February and March last year. And there's a few things to consider, right? There's one, companies are better equipped to handle lockdowns and have invested more into reshoring as well as developing an online presence. Secondly, the Fed will likely be less hawkish, and that is usually a tailwind for equities. So while there could be a significant decline in equities, in the worst case, I don't believe it'll be anywhere near the magnitude of early 2020. But there are signs that are showing some similarity to the early days of the pandemic. Taking a look at bonds, fundamentals have played a big part here in bonds. While we were initially bearish, I do think that this new news on Friday, you got to change your sentiments. It does provide a more uncertain picture, and investors are naturally going to flee to more safer assets and out of equities. So we are seeing that demand in bonds here, especially in TLT. We can see here the 151 resistance level, fairly strong resistance level, has provided resistance, and price rejected it on a number of occasions, 1, 2, 3, 4 times already. But it looks like price is heading back to that level, and strong momentum here, or growing momentum. So it does provide evidence that this level might be broken out of, and especially with the fundamental catalyst of the new variant, there may be more upside here for TLT The next key level, you really have to look at the weekly chart, but the next key level that I would consider here would be 155 or so. But I think sentiment in bonds has definitely shifted, especially on the shorter term, but that will also have an impact on the longer term, longer duration bonds as well. So I want to keep an eye out and keep an eye on this 151 level, as should that break, that does provide evidence of that move back to 155. So that leads us to yields, which again, very choppy, very volatile, but at the same time, just moving sideways here within this range. 170 basis points seems to be a resistance area here for yields. And again, based on Friday's news, we can see that yields are plunging. I do think that 137 basis points is definitely a possibility this week or in the next week or two, as yields continue to decline. And that really doesn't paint a positive picture for financials in general. And especially when you consider the fact that, with the risk of this new variant, Fed will have to be less hawkish, and all the pricing in of those two interest rate hikes, that'll have an impact on bonds, that'll have an impact on financials, and, especially that are financial stocks that are highly exposed to yields and that want higher yields. I do think that those may be the names we want to avoid here. So yields definitely further downside here, in my opinion. Taking a look at the US dollar index. So the possibility of a less hawkish Fed will naturally drive the dollar lower, but you have to remember that its value is based against a basket of other currencies, right? So with the euro having the highest weighting, I do think that this pullback is temporary, because at the end of the day, Europe is in no position to raise rates anytime soon compared to the US. And I do think that right now price was definitely overbought. It diverged fairly significantly from its moving averages. It was above the 200 level here on its CCI. I do think there's more downside here for a pullback in the currency index. First area of support would be around here, just below where it's trading at now. And should it break that level, the next key area of support would be the 94.5 level, which was the previous resistance level for a couple of weeks or so. Taking a look at crude and a complete shift in sentiment, what we can see here at 84 was a strong resistance level. Price did pull back to and initially found support at around 78, eventually broke that level, and it kept on breaking support levels in the last couple of weeks. And kept on breaking support levels in the last couple of weeks, especially the 75 level. That was a fairly significant level that it broke below, with strong bearish momentum. And fundamentals do play a big part here. As much as OPEC can decide to cut supply as much as they want, at the end of the day, if countries go into lockdown, especially now with a new variant in play, that really does drive demand lower here. So I think the next level here to be made aware of would be a 66.50 level. And should that level break, and based on its bearish momentum, that looks likely, the next key level to be made aware of here would be 62 or so. So taking a look at some of the sectors, last week we saw a very strong sector performance. We have 10 out of the 11 sectors that were all showing bullish trends, with the exception of communications, which was the only sector that was on a bearish trend. Now that's starting to weaken. We have communications that's continuing its bearish trend. We have financials that's shifted to neutral on the back of lower yields, and we have lower rates, and we have energy again. Lower oil prices has turned the sector neutral.
Hey there. Thank you so much for watching. I really hope that you enjoyed today's session. If you want to watch the full recording and all of the market mover symbols that I covered today, register for an account at OptionsPlay.com. You will access my daily trading signals to follow along and weekly options education sessions to improve your trading skills, and gain full access to our platform to analyze the risks, rewards, and probabilities for any trade. Regardless of where your ideas originated from, filter them out with OptionsPlay and start gaining confidence in your trades with our platform. And the best part is that you can start completely free with a 30-day trial. Click on the link in the description below to learn more. And as always, have a great trading day.